Welcome back. We're jumping straight in today with a look at the strategic analysis of RZLV AI, that's RZLV, and its new reseller partnerships with Microsoft and Google Cloud.
Right. It's a piece focused on massive projected revenue growth and the de-risking that these deals imply.
And look, while the material does a great job establishing that commercial momentum, the narrative needs to more explicitly validate the underlying technology that these titans are actually selling, the RZLV Brain Suite.
I completely agree. The commercial validation from Microsoft and Google is powerful. I mean, getting co-sell ready status from both of them it's huge.
It is. It definitely signals a high level of trust in RZLV as a viable partner.
But if we want the reader to really buy into those forward-looking revenue projections, which are, extremely ambitious, we need a stronger foundation. It has to go beyond just distribution.
Exactly. The report jumps right to the financials. It uses that co-sell ready status to imply trust, but the product itself, the Brain Suite, it's basically treated like a black box.
Yes. The focus is all on who is selling it, not why RZLV's specific AI was picked over, everything else on the market.
And when you see forecasts jumping to $150 million in ARR for 2025, then $500 million in 2026.
A jump of that size just screams disruptive tech.
Right. So there's this logical gap for any sophisticated reader, especially for the big enterprises reading an opening bell report. They have to understand the competitive edge.
You can't justify that kind of distribution acceleration without showing a real technological advantage. It just doesn't track.
That's the core of it. So the suggestion for improvement is to carve out a dedicated, focused section.
To really articulate the unique value proposition.
Yes, spell out the technological superiority of the Brain Suite. What made it so indispensable that both Azure and Google Cloud had to have it? You can't let the partnership mechanics do all the heavy lifting for the value prop.
The partnership proves it's marketable, for sure.
But we still need proof that it's superior.
So let's make that actionable. We could, for example, introduce a short, punchy section that just answers one question. What problem does RZLV solve that Microsoft and Google can't solve internally right now?
Oh, I like that. That framing immediately positions RZLV as an essential piece of the puzzle.
Not just another add-on they could swap out next year. It shows a specific critical need.
And if the details are out there, you could use integration points as the proof. The piece mentions possible tie-ins to Google Search, to Maps, to the whole Android ecosystem.
You use those specific roadmap integrations as evidence. It shows that Microsoft and Google are committing future development resources to this thing.
It shifts the narrative from they are selling it to they need it.
And you have to link those unique tech features directly to the reason why Microsoft signed a 5-year go-to-market agreement.
A 5-year deal? I mean, that's an eternity in AI.
Exactly. A commitment of that size has to be backed by a deep technological moat, something proprietary that ensures they won't just, build their own version in 2 years.
So strengthening that part of the analysis ensures the entire bull case doesn't just rest on channel sales.
It rests on a superior product being sold through superior channels. A much stronger argument.
Right. The goal is to make the reader think Microsoft requires RZLV to fill a critical gap, not just Microsoft is selling RZLV because they have shelf space. That pivot is everything.
And with that foundation sorted, let's talk about risk. Because for the de-risking narrative to actually work, we have to look at the challenges seriously.
Yes, and the current bear case is a little too general. It focuses on whether RZLV can handle the scale and if the sales reps are trained.
Which is really just table stakes, low-hanging fruit.
To really de-risk the stock story, the bear case has to move beyond those generic technical risks. It needs to address the specific structural vulnerability you get when you rely on massive third-party sales teams.
The organizational execution risk. That's the real threat here.
Yes. The weakness in the current analysis is that the bear case overlooks the biggest organizational danger, which is just becoming a low-priority SKU.
A stock-keeping unit? Just another line item in a massive catalog?
You're dealing with these huge complex internal sales incentives, organizational politics. RZLV could get sidelined in a heartbeat.
And the stakes couldn't be higher. The report says over 50% of its forecasted future revenue will come directly through Google sales channels.
That makes RZLV acutely vulnerable. The second Google's or Microsoft's internal priorities change, or a new proprietary product gets a better commission,
poof, it's gone from the sales deck. It's the difference between a technical problem, which you can usually solve with money, and a behavioral or political one, which is much, much harder to fix.
So the suggestion is to introduce this idea and really analyze the challenge of maintaining that top-of-mind priority for a small-cap product inside the Microsoft and Google machines.
It requires a sustained, focused strategy. How does RZLV plan to counter that organizational friction?
You have to think like a sales rep at one of these giants. They're incentivized to sell what's easiest, what's most profitable for them personally, or whatever is the highest priority for their team's quota that quarter.
So if some competing internal product offers a slightly higher commission?
The small cap product just vanishes.
Exactly. So let's make this actionable. Shift the critique. Instead of asking, can RZLV scale the tech, which is the easy question?
We need to ask the harder, more critical question. Can RZLV maintain mindshare within Microsoft's global sales force over the long haul?
That's not about training. That's about continuously marketing to the sales teams themselves.
A crucial distinction. The analysis needs to explicitly explore how RZLV plans to stop their product from getting buried. Ignoring that risk, it suggests an incomplete understanding of how these channels actually work.
And there's another layer here. The material correctly points out that the customer acquisition cost, the CAC, drops a lot when the giants do the selling.
Which is great.
But we have to analyze the inverse metric, the potential for sales cycle inertia.
So low CAC is great for your margins, but if the product isn't being actively pushed,
The sales cycles just drag on forever and you miss those aggressive revenue targets.
analyzing that inertia risk would make the bear case so much more sophisticated. It would show an understanding of both the massive upside and the Achilles heel of the whole setup.
And this actually leads us right to what I think is the most powerful part of the entire analysis. And it's something that is right now completely buried.
The financial engineering. I know exactly what you're talking about.
The mechanism that lets customers use their Google Cloud commitments.
Using their prepaid, often stranded cloud credits to basically get Resolve AI for free? It is without a doubt the single most potent financial incentive in the entire report.
And it needs to be elevated. It should be the headline of the bull case, not a footnote.
The weakness is that this killer detail, this free acquisition mechanic that just short-circuits the entire enterprise sales cycle, is buried. It's a sub-point under the Google partnership section.
It's treated like a tiny detail instead of the strategic driver of the whole thing.
It's the engine. It's the frictionless sales they talk about. If the analysis is going to claim RZLV can hit $500 million in ARR by 2026, mostly from Google,
This credit utilization feature is probably the single biggest reason why that's even plausible. It's an instant budget solution for the enterprise buyer.
so the suggestion is pretty straightforward then.
Restructure the analysis to lead with this. Use this frictionless sales opportunity to frame and validate those huge growth targets.
It moves the conversation from just, they have big partners, to, they have partners using a brilliant financial hook to create insane sales velocity.
So how do we make sure it has immediate impact? What's the practical change?
I think you have to move it, integrate it directly into the Why This Matters Now section.
Right now, that section is a bit general. It talks about revenue validation and de-risking the stock.
By putting the cloud commitment mechanic right there, you make it the key differentiator. It becomes the proof point that validates the crazy growth guidance. It goes from being a key detail to a strategic driver.
That elevation is so important because it answers the how. How is this aggressive growth even possible? This is the secret sauce. It removes the biggest hurdle in B2B sales.
Which is always getting new budget approved.
Always. And to really drive it home, you should use this point to contrast RZLV's position with the typical small company.
Right. Most small companies get crippled by customer acquisition costs.
But RZLV, because of this mechanic, gets a uniquely low, maybe even zero effective CAC. They're just tapping into budget the customers already spent.
Highlighting that CAC difference, backed by a specific example like the credit utilization, that instantly reinforces the de-risking the stock argument for anyone who understands finance.
This is the financial engineering that makes the partnership revolutionary, not just transactional.
When you can tell a CFO they can get cutting-edge AI using money they were about to lose anyway,
That is a purchasing friction killer. It deserves to be front and center in the most impactful part of the report.
this has been a really focused critique. I think addressing these structural points will sharpen the material's impact immensely. So, to summarize our actionable suggestions for the listener.
Okay. First, integrate the competitive advantage of the RZLV Brain Suite into the course story. You need to prove the tech superiority that underpins the growth projections. Don't just rely on the channel.
Second, deepen the bear case. You have to address the specific organizational execution risk, that danger of becoming a low-priority SKU, and analyze how RZLV plans to maintain that critical mindshare inside these giant sales organizations.
And finally, structurally emphasize the unique financial leverage of the Google Cloud commitments. Elevate that frictionless sales mechanism from a buried detail to a central strategic driver that makes the rapid ARR acceleration feel not just possible, but logical.
Addressing those gaps will make the analysis robust, logical, and just much more resilient to counter arguments.
Absolutely.
We look forward